Nicholas P. Sargent, JPMorgan's Fall and Revival, How the Wave of Consolidation Changed America's Premier Bank. Preface. Book overview. This book tells the story of JPMorgan's evolution from a leading bank to its acquisition by Chase and subsequent emergence as a financial powerhouse. It begins where Ron Cherno's work left off, detailing challenges faced by leaders Lew Preston and Dennis Weatherstone in the 1980s. Key themes: JPMorgan struggled to adapt to market changes and maintain its position as a leading wholesale bank. The firm's reluctance to pursue retail banking and acquisitions, instead choosing to grow organically. The strategic decisions that left Morgan vulnerable to acquisition due to dependence on volatile trading revenues. Historical context: analysis of the broader U.S. banking landscape during turbulent periods in the 1980s and 1990s. The impact of deregulation and the consolidation of financial institutions, leading to debates about the concentration of assets and the too-big-to-fail phenomenon. Personal motivation: the author's inspiration stemmed from attending a 2018 reunion of Morgan alumni, sparking reflections on the firm's legacy and culture. The book draws on the author's first-hand experience at Morgan, complemented by interviews with former colleagues and senior executives. Acknowledgements: tribute to JPMorgan and the people who shaped its legacy. Gratitude expressed to various individuals who supported the author during the writing process, including colleagues, industry experts, and family members. Dedication to the author's family, with hopes that future generations will understand his contributions through this work. 123 Wall Street. Location and significance of 23 Wall Street. The building at 23 Wall Street, known as the Corner, was the headquarters of the Morgan Guaranty Trust Company. Positioned strategically at the apex of a triangle formed with Federal Hall and the New York Stock Exchange. Historically significant as Morgan acted as the de facto central bank of the U.S. before the Federal Reserve's creation in 1914. Architectural and atmospheric description: entering the building felt like stepping into a European, cosmopolitan world. Interior featured vast spaces with white marble floors and walls, contrasted by green brocade panels. A massive crystal chandelier adorned the three-story ceiling of the lobby. The ambience was quiet and eerie, with bankers working silently behind luxurious roll-top desks, with no visible customers. Apprehension and prestige: the author felt apprehensive due to the prestigious reputation of Morgan as an elite bank. Elmore Patterson, the then chairman and CEO, had a significant background in banking and played a crucial role during New York City's financial troubles in the mid-1970s. Walter Hines Page, the president, was connected to prominent figures and had extensive international experience, including setting up offices in key global cities and collaborating closely with Saudi Arabia's central bank. Interview process and key figures: the author was interviewed by several high-profile figures, each contributing to the bank's global stature. Dennis Weatherstone, treasurer of the company, with a background in foreign exchange trading, known for his intelligence and market savvy. Bruce Brackenridge, head of the administration division, who discussed the bank's involvement in lending to developing countries and his excitement for the bank's future role. Jack Noyes, chief economist, formerly head of the research division at the Federal Reserve, who led the bank's economic publication, the Morgan Guaranty Survey. Rimmer de Vries, head of the International Economics Department, editor of the influential publication World Financial Markets, and a prominent international economist. Personal dilemmas and decision: the author faced a dilemma between accepting a prestigious career opportunity at Morgan and maintaining a preferred lifestyle in the West. Initially struggled with intelligence and personality tests due to jet lag, but eventually performed well. Decision-making involved considering advice from a mentor, the impact on family life, and balancing career prestige versus personal satisfaction. Ultimately, the author accepted the offer after receiving counsel that he was too young to prioritize lifestyle over career advancement. Rimmer de Vries hospitality: Rimmer de Vries invited the author to his farm in Oldwick, New Jersey, showcasing a down-to-earth lifestyle despite his high-profile Wall Street position. This visit helped ease concerns about relocating to New York and solidified the decision to accept the job offer. Historical context of 23 Wall Street: the Corner, the building, completed in 1914, symbolized the stability and wealth of JPMorgan's firm. It featured a cornerstone with significant historical documents, including JPMorgan's will and testimony to the Pujo Committee, which investigated the money trust. The building was the site of a notorious bombing on September 16, 1920, which killed 30 people and left permanent marks on the building's marble exterior. 2A Private Club First Day at Morgan, 1978. The author begins his career on Wall Street at Morgan in 1978, feeling confident about joining a prestigious institution. Family and friends affirm Morgan's reputation as the best bank globally and a class act. Morgan's historic role. Julius Pierpont Morgan's legacy in financing American railroads and shaping the steel industry is acknowledged. The author is particularly intrigued by Morgan's role as a financial advisor to governments and a quasi-central bank, notably during the 1907 financial crisis. Morgan's reputation and secrecy. The firm's aversion to publicity is highlighted, with anecdotes about the lack of signage and minimal advertising. Employees were discouraged from speaking to the press, except for Rimmer de Vries, who was cited in the media on international issues. Mystique of Morgan. The firm's discreet style is compared to a private club, offering an exclusive membership to its clients, as described in Ron Chernow's The House of Morgan. Work culture at Morgan. The author reflects on his anticipation about working at such a unique firm and whether it would live up to its reputation. Over the next 6 years, the author discovers that Morgan's success partly lies in making employees feel part of a special club. Core values and traditions. Morgan's core values of integrity, respect, and teamwork are ingrained in employees from the start, supported by the firm's motto, "First-class business in a first-class way." These values are reinforced through a strict code of behavior and a structured training program for college recruits, fostering a strong sense of loyalty and pride. Departmental bonding. The author, as a mid-career hire in the International Economics Department, did not participate in the training program but still felt a sense of pride and camaraderie with his department colleagues. The department was respected within Morgan, with seating arrangements reflecting titles and ranks. Work environment. The bullpen area, where the economists worked, was quiet, almost like a library, requiring lowered voices. Traditions like wearing suit coats outside the work area and the revered practice of providing free lunch contributed to the firm's unique culture. Officers' dining room. Officers enjoyed a superb 5-course meal with cigars, fostering camaraderie among colleagues. The author appreciates the high-quality cuisine and interesting company, comparing it to a country club experience. End of workday. The workday for the International Economics Department was dictated by train schedules, with senior members leaving first. Despite initial concerns, the author found his work-life balance similar to his previous government role, with time for family in the evenings. Morgan's global reach. By the late 1970s, Morgan had about 8,000 employees, with 10% being officers, but the firm felt intimate due to its concentrated presence in New York, London, and Tokyo. The International Economics Department played a critical role in the firm's business, especially in monitoring and forecasting economic developments in countries where Morgan had exposure. International lending. The department's work was crucial during the surge in international lending post-1973-74 oil shock, with a focus on Latin America and Asia. The author's team covered countries in Asia and the Pacific Rim, working closely with bankers and hiring economists fluent in regional languages. Early warning system. The author was tasked with developing an early warning system to detect potential country defaults, building on his experience at the Federal Reserve. The system focused on inflationary policies and currency pegs as key indicators of default risk. Country risk assessment. Morgan's system for assessing country credit risk was among the best but still faced challenges due to the lack of timely data on external debt. The department filled gaps in information by gathering data from private sources and projecting countries' borrowing requirements. U.S. economic conditions. In 1978, while developing countries showed improvement, the U.S. faced deteriorating economic conditions, including a depreciating dollar and rising inflation. The department worked closely with Morgan's Treasury Division and Foreign Exchange Advisory Group to alert traders and clients to these risks. Collaboration with IFM. The department collaborated with International Financial Management, IFM, to advise multinational corporations on financing strategies, cautioning against borrowing in low-interest rate countries like Switzerland and Germany due to currency risks. Advising central bankers. The author also worked with a unit advising central bankers on economic and market developments, meeting officials who later became heads of central banks. Critique of U.S. policy. The department was critical of the Carter administration's fiscal policy and the Federal Reserve's gradualist approach, advocating for tighter policies to control inflation and support the dollar. End-of-year celebration. The year concluded with a gala Christmas party, where Morgan's success was celebrated, and changes in leadership were announced, positioning Dennis Weatherstone as a future chairman. Morgan Creed and Training Program. The Morgan Creed, articulated by JPMorgan Jr. in 1933, emphasized the professional ethics of bankers, the importance of credit, and the responsibility to the community. The training program, established post-testimony, focused on developing character, loyalty, and a deep understanding of the bank and its customers, maintaining Morgan's reputation for integrity. 3. Preston in charge. Background and early life. Born in New York City on August 5, 1926, Lew Preston hailed from a prestigious family with deep American roots dating back to the 17th century. Preston grew up in New York and Paris, partly raised by the Harriman family after his father's untimely death and his mother's poor health. Educated at St. Paul's School in New Hampshire, Preston enlisted as a Marine during World War II, serving in China after Japan's surrender. After military service, Preston attended Harvard, where he captained the ice hockey team, and graduated in 1951 before joining Morgan. 2. Early career at Morgan. Preston began his career in Morgan's National Division, focusing on the oil sector, a field of interest due to his family's investments in Texas oil drilling. His background in commodities and markets made him a strong candidate for leadership roles within Morgan, drawing comparisons to previous leaders like Pat Patterson. 3. Leadership and London office tenure. In 1966, Preston became head of Morgan's London office, succeeding Don Atke after his death. This role was a traditional stepping stone to higher positions at Morgan. During his tenure, Preston expanded Morgan's activities in the burgeoning Eurodollar market, driven by the U.S. government's Interest Equalization Tax, IET, that pushed financial activity to London. Preston and Dennis Weatherstone partnered to extend Morgan's dealing room activities in London, pioneering long-dated forward contracts and establishing a Eurobond trading function. Preston also played a key role in creating the Euroclear system to facilitate the settlement of Eurobond trades, despite initial financial losses due to unsuccessful syndication efforts. 4. Return to New York and expansion of International Division. In 1968, Preston returned to New York as head of the International Division, where he expanded Morgan's footprint in Asia and Latin America. Preston's leadership saw Morgan's involvement in various international ventures, including significant investments in Japan, Singapore, and Indonesia. Morgan's push into Latin America under Preston's guidance was substantial, with Morgan catching up to competitors in the region by the late 1970s, though this expansion did not end favorably. 5. Challenges and strategic decisions. Preston faced significant challenges when he took over Morgan in 1979, including high inflation, rising interest rates, and the deregulation of the U.S. banking industry. He recognized the need for Morgan to adapt to the changing banking landscape while maintaining its core values, emphasizing the importance of serving multinational clients with sophisticated advice. Under Preston's leadership, Morgan navigated the complex and turbulent financial environment of the late 1970s and 1980s, ensuring the bank remained competitive amidst industry transformation. 6. Competitive landscape. During Preston's tenure, Morgan's primary competitors included other major New York-based banks like Citibank and Chase Manhattan, both of which were expanding their international operations and adapting to the evolving financial markets. Citibank, under Walter Wriston, was particularly innovative, focusing on lending to less developed countries and expanding its global presence, while Chase Manhattan, under David Rockefeller, pursued similar international expansion. Chemical Bank and Bankers Trust also pursued distinct strategies, with Chemical focusing on domestic acquisitions and Bankers Trust shifting towards wholesale banking. 7. Legacy and strategic vision. Preston's legacy at Morgan is marked by his efforts to balance the bank's transformation with adherence to its core values, ensuring that Morgan remained a leading institution in the rapidly changing financial industry. His strategic decisions, including bringing Dennis Weatherstone to New York and expanding Morgan's international division, were pivotal in positioning Morgan to navigate the challenges of the era. 8. Special relationship with Japan. Preston's tenure also reinforced Morgan's special relationship with Japan, which dated back to the 1920s. This relationship was solidified through various financial and political ties, including the establishment of Morgan's Tokyo branch in 1969. Morgan's influence in Japan was significant, with leaders like John Mayer continuing to foster strong ties between the bank and Japanese government and business entities. 4. Market shocks. Iranian Revolution and oil price surge. 1979 Iranian Revolution led to Shah's exile and Khomeini's return, resulting in the establishment of an Islamic Republic. Strikes in Iran's oil refineries reduced production from 6 million bpd to 1.5 million bpd. Oil prices surged, with West Texas Intermediate increasing from $10 to nearly $40 per barrel between December 1978 and March 1980. OPEC surplus and global financial impact. OPEC's current account surplus grew from a small deficit in 1978 to $60 billion in 1979 and $110 billion in 1980. Morgan Guaranty capitalized on the situation by lending to oil-importing countries, with a focus on developing countries reliant on bank financing. Credit risk assessment and regional strategies. Morgan Guaranty developed a framework to rank the creditworthiness of 20 developing countries, with a focus on Asia, Latin America, and the Middle East. Asian countries were seen as relatively creditworthy, particularly those pursuing export-led growth, e.g., South Korea, Taiwan. Latin America posed higher risks due to industrialization behind high tariff barriers, large budget deficits, and frequent currency devaluations. Shift in U.S. monetary policy. Volcker's Fed chairmanship. Paul Volcker became Fed chairman in August 1979, replacing G. William Miller. Volcker introduced a shift to targeting money supply growth rather than the federal funds rate, leading to unprecedented volatility in interest rates. Short-term interest rates surged above 20%, and the Treasury yield curve inverted, indicating a likely recession. Reaganomics and global economic impact. 1981. Ronald Reagan's 1981 economic program focused on reducing government spending, lowering marginal tax rates, diminishing regulation, and controlling money supply growth. The mix of expansionary fiscal policy and restrictive monetary policy led to a strong dollar and attracted foreign investment in U.S. Treasuries. Despite high interest rates, Morgan Guaranty navigated this volatile period successfully, thanks to experienced market professionals. Global economic weakening. 1982. By early 1982, signs of economic weakening became apparent, with declining prices for gold, oil, and other commodities. Fed officials, concerned about persistent inflation expectations, considered additional monetary tightening. 5. Crisis erupts. 1. Global economic environment. By the early 1980s, the global economic environment became less favorable for developing countries, with key Latin American borrowers exceeding the 20% debt service ratio, previously considered excessive. 2. Bankers' confidence. Despite high debt levels, Latin American bankers argued that leading countries could borrow more to cover foreign exchange shortfalls, making traditional debt service capacity measures irrelevant. This led to increased credit limits for the region by Morgan and other multinational banks, influenced by Citibank's CEO, Walter Wriston, who famously stated that sovereign countries do not go bankrupt. 3. Internal concerns. Rimmer and others in the International Economics Department were uncomfortable with the assumption that countries could always obtain additional financing. Although an early warning system developed by Nick, the narrator, flashed red for several countries, he initially dismissed it due to the concurrent double-digit inflation in developed countries. 4. Asia Region Assessment. Amidst the controversy, Nick toured Asia to assess the economic situation, finding that the region was in good shape but needed close monitoring, especially in the Philippines and Indonesia. In Japan, discussions with top officials reassured him about the country's upcoming financial liberalization. 5. Warning signs from Mexico. A meeting with Senator Bill Bradley revealed Mexico's dire economic and political situation, which was dismissed by Morgan's Latin American bankers. They even requested an optimistic feature on Mexico in the August issue of World Financial Markets. 6. Crisis unfolds. During Nick's vacation, news broke that Mexico had run out of foreign exchange reserves, triggering ripple effects across Argentina, Brazil, Venezuela, and other Latin American borrowers. Morgan's exposure to these countries totaled $4.1 billion, representing a significant risk to the bank's capital. 7. Banking crisis response. Senior management, particularly Dennis Weatherstone, was alarmed by the crisis. Efforts were underway to arrange bridge financing from the U.S. government, BIS, and IMF, while concerns grew about the solvency of major borrowers like Mexico, Brazil, Argentina, and Venezuela. 8. Country-specific challenges. Mexico. Outgoing President López Portillo's nationalization of banks and foreign exchange controls created panic. Argentina. The country faced hyperinflation and depleted reserves, exacerbated by the Falklands War. Brazil. Despite economic strength, Political transitions complicated debt negotiations. Venezuela. Considered a renegade, Venezuela demanded concessions despite a relatively low debt burden. 9. Internal divisions at Morgan. Within Morgan, opinions were split. Some, like Jackson Gilbert and Tony Gebauer, viewed the crisis as a liquidity issue and advocated for increased exposure to Latin America, while others, including Rimmer, saw it as a solvency problem requiring debt reduction. 10. World financial market strategy. Rimmer intended to use world financial markets to shape public opinion and convince Morgan's senior management to prepare for a long-term workout, emphasizing the need for debt burden reduction and caution against further lending. 11. IMF's role. The department believed that only the IMF could coordinate the complex process of managing the crisis, which now involved setting conditions for both debtor countries and commercial banks, a novel approach at the time. 12. Global market dynamics. Positive developments, such as falling commodity prices and declining interest rates, helped stave off immediate disaster. However, the situation remained precarious as the recession in the US and other industrial countries impacted the LDC's ability to service their debts. 13. Uncertainty and hope. As the year ended, Morgan's staff faced the dual challenge of managing the ongoing crisis while cautiously optimistic about signs of economic recovery in the US. The future of Morgan Guaranty remained uncertain as the bank navigated the fallout from the Latin American debt crisis. 6. Time to say goodbye. 1983 financial context. Multinational banks, including Morgan, were extending bridge loans to developing countries facing significant debt burdens. Morgan's management, led by Lew Preston, recognized a long workout period ahead and formulated a strategy for future lending to developing countries. Managed lending strategy. Morgan adopted a managed lending strategy, rejecting a global approach to the LDC, less developed countries, debt problem in favor of case-by-case solutions. Morgan opposed debt relief for fear of setting a precedent that would encourage other countries to seek similar assistance. The strategy focused on maintaining banks' capital and balance sheets by rolling over loans at par value, supported by regulatory forbearance, which allowed banks to mark LDC loans at par as long as interest payments were current. Regulatory and collective action. U.S. government and regulatory bodies supported the rollover process, which helped banks avoid immediate losses. A burden-sharing concept was proposed to keep smaller and regional banks aligned, avoiding free riders and ensuring collective action among U.S. and European banks. Morgan and Deutsche Bank collaboration. Morgan sought to keep bank syndications intact by collaborating with Deutsche Bank to form a behind-the-scenes steering committee. This collaboration aimed to maintain the coalition of banks supporting troubled countries, with Morgan demonstrating leadership by moderately increasing exposure to major borrowers except Venezuela, which was considered a freeloader. Personal career shift. The author observed the challenges faced by Morgan and other banks in maintaining their roles during the LDC debt crisis and began to question the future of commercial banking. A conversation with Bruce Britton from Salomon Brothers highlighted the innovative and fast-paced environment at investment banks, contrasting with a more traditional approach at Morgan. The author was later approached by Salomon Brothers for a position in their bond market research department, leading to a career shift from Morgan to Salomon. Decision to leave Morgan. The author faced a difficult decision between staying at Morgan, where he felt part of a family, and moving to Salomon Brothers, where financial innovation and securities were the future. Concerns about becoming outmoded at Morgan due to a lack of exposure to financial engineering played a significant role in the decision. Transition to Salomon Brothers. The author left Morgan in January 1984, recognizing that Morgan had navigated the LDC debt crisis better than its competitors and was a paragon of the banking industry. Despite Morgan's strong position, the author was drawn to the innovative environment at Salomon Brothers, where bond financing was becoming the primary funding vehicle for corporations. The departure from Morgan was marked by a warm send-off and a handwritten note from Dennis Weatherstone, reflecting Morgan's class act and unique culture. Morgan's future direction. Lew Preston was committed to transforming Morgan into a universal bank, despite challenges posed by the Glass-Steagall Act. Morgan expanded its securities and trading capabilities abroad, particularly in London, while striving to maintain its unique culture and identity. Final reflections. The author's decision to move to Salomon Brothers was driven by the recognition that investment banking and financial innovation were shaping the future of international finance. The transition marked a significant shift from the traditional, stability-focused approach of Morgan to the dynamic and innovative environment at Salomon Brothers. Part 2, Formulating the Plan's 7 Origins of Morgan's Transformation 1984 Overview. Morgan had successfully navigated the LDC debt crisis, positioning itself as a leader in the banking industry. However, Lew Preston recognized the need for transformation to compete not only with money center and foreign banks but also with emerging securities firms, despite Glass-Steagall barriers. New York Times article, 1983. The article praised Morgan as the epitome of a well-run, profitable bank, admired by peers like Bankers Trust and Citicorp. It highlighted Morgan's challenge in maintaining its elite customer base in a rapidly changing financial landscape. Banking industry turbulence. The banking industry underwent significant consolidation from the mid-1970s through the mid-1990s, driven by inflation, interest rate fluctuations, and legislative changes allowing banks to accept out-of-state deposits. The number of U.S. commercial banks dropped by 36% during this period, and the share of assets held by small banks decreased while megabanks' share doubled. Disintermediation and competition. U.S. banks, including Morgan, faced disintermediation as corporate customers increasingly turned to capital markets and foreign banks for financing. By 1994, U.S. banks' share of credit market debt had fallen to 17% from 26% in 1979, while foreign banks' share of U.S. corporate debt financing rose to 13.4%. Morgan's funding strategy. Unlike its competitors, Morgan was a wholesale bank, relying on interbank market borrowing rather than customer deposits. However, regulatory changes indirectly affected Morgan by enabling competitors to grow larger through mergers. Morgan's capital increase. In response to competitive pressures, Morgan increased its capital by $900 million between 1982 and 1983. Rival Citibank strategy. Citibank, under Walter Wriston, expanded globally and embraced consumer technology, including ATMs and credit cards. Preston, however, believed Citibank's dual focus on corporate and retail clients was unsustainable. Morgan's core competencies. Preston identified Morgan's strengths in advising elite clients on sophisticated transactions and innovative financing, such as linking debt warrants to zero-coupon bonds. Morgan's expansion into financial futures. Morgan opened a subsidiary, Morgan Futures Corporation, in 1981, to enter the financial futures market, securing seats on major commodity exchanges and ramping up trading activities in gold and precious metals. Chemical bank strategy. Competitor Chemical Bank pursued domestic growth through acquisitions and created a lucrative loan syndications business, which Morgan was slow to enter. Preston's vision of a universal bank. Preston considered transforming Morgan into a universal bank, offering a full range of commercial and investment banking services. He was particularly inspired by Morgan Stanley's transformation into a global investment bank. Glass-Steagall barriers. The main obstacle to Morgan's transformation was the Glass-Steagall Act, which prevented commercial banks from engaging in securities business in the U.S. Morgan began expanding its international capabilities in London, Frankfurt, Zurich, and other major financial centers to circumvent these restrictions. Morgan Guaranty Limited, MGL in 1979, Morgan created MGL, which became a leading underwriter of Eurobonds by 1984, allowing Morgan to divest its stake in Morgan Grenfell. Challenges and setbacks. Morgan faced difficulties with new financial structures, like perpetual floating rate notes, leading to capital losses and the need for recapitalization. Despite setbacks, Morgan continued its push into international securities markets. Continental Bank collapse. 1984. The near failure of Continental Bank, a major commercial lender, underscored the risks of relying on loans for growth. This event reinforced Morgan's management's resolve to diversify and lobby for regulatory changes. Lobbying against Glass-Steagall. Preston led efforts to lobby the Federal Reserve and Congress for relief from Glass-Steagall restrictions, ultimately issuing a report in 1984 advocating for the ability of bank holding company subsidiaries to underwrite and deal in corporate securities. Strategic decision. 1986. In 1986, after intense internal debate, Preston decided to proceed with transforming Morgan into a universal bank, despite internal resistance and external challenges. Waiting game for regulatory change. Morgan played a waiting game, expanding its securities business within Glass-Steagall constraints, and eventually gained momentum when Alan Greenspan became Fed chairman in 1987, more sympathetic to dismantling Glass-Steagall. JPMorgan historical note. The origins of JPMorgan trace back to Junius S. Morgan and his partnership with George Peabody in 1854, evolving through alliances and significant contributions to the U.S. and global financial markets. The firm became a central figure in U.S. financial history, often stepping in to stabilize markets during crises. 1. Strategic direction. Morgan's senior management committed to transitioning the firm into securities and investment banking. 2. Potential strategies. Acquisition for expertise or organic growth. Lew Preston favored internal development but was open to targeted acquisitions that fit strategically. 2. Aversion to major acquisitions. Preston's resistance to acquisitions was based on preservation of Morgan's unique corporate culture focused on teamwork and customer interests. Historical caution due to only one significant merger with Guaranty Trust Co. in 1959, which revitalized Morgan but was exceptional due to strong synergy. 3. Historical merger success. The merger with Guaranty Trust was highly successful, combining complementary strengths. The merger positioned Morgan as one of the most powerful financial institutions globally, with a leading position in trading and international markets. 4. Focus on fortress balance sheet. Morgan prioritized maintaining a strong balance sheet, becoming the only U.S. commercial bank with AAA-rated bonds by Standard & Poor's. The bank maintained higher reserves against possible loan losses compared to competitors, ensuring stability against financial shocks. 5. Organizational restructuring. 1985. Reassignment of senior executives to adapt to the evolving business environment. 1986. Further reorganization merged commercial lending with limited investment banking operations, placing Robert Engel in charge, overseeing the majority of the firm's profits. 6. Cultural and organizational challenges. Management aimed to retrain commercial bankers to become investment bankers, risking a culture clash. McKinsey & Company advised on industry best practices, highlighting Morgan's lag behind Citibank. A rigorous training program was implemented, integrating Morgan's culture with new financial market skills. 7. Expansion into investment banking. London and New York became focal points for Morgan's expansion into corporate finance, leveraging deregulation opportunities like the Big Bang in London. Sandy Warner led the London office's transformation, emphasizing recruitment and adaptation to new competitive demands. 8. Integration and compensation challenges. The transition required molding traditional bankers into versatile investment bankers, which led to internal tensions and departures. Compensation disparities became a key issue, with Preston cautious about entering a bidding war for top talent to preserve team spirit. 9. Case study. Rafe de la Garonnière. Garonnière's departure to Payne Webber highlighted the challenge of retaining top talent in a competitive compensation environment, leading to a shift in Morgan's approach to rewarding star performers. 10. Real estate and cost management. The search for new headquarters led to a controversial and costly decision to build at 60 Wall Street, reflecting the firm's need to accommodate growth despite internal disagreements. 11. Formation of JPMorgan Securities Inc. In 1987, Morgan established JPMorgan Securities Inc. with an initial capitalization of $250 million, signaling its commitment to entering the securities and investment banking sectors despite potential legal challenges under Glass-Steagall. 12. Commitment to long-term goals. Despite the high costs and organizational challenges, Morgan's management remained steadfast in its strategy to build a competitive securities and investment banking business from scratch. 9. Industry shakeup. Mid-1980s environment. The securities business was thriving due to favorable economic conditions, interest rates had fallen, and both economic growth and corporate profits were strong following the 1982-83 recession. Bond yield reversal. In early 1987, bond yields began rising after years of decline, primarily due to Japanese investors scaling back their purchases of U.S. treasuries as the U.S. dollar weakened against the yen. Louvre Accord. The Louvre Accord in February 1987 aimed to stabilize the dollar and financial markets. The Federal Reserve raised short-term interest rates, while the Bank of Japan and Bundesbank lowered theirs, initially calming the markets. Market volatility. The markets became volatile in August 1987 when Alan Greenspan replaced Paul Volcker as chairman of the Federal Reserve. Greenspan's initial rate hike of 50 basis points failed to stabilize the markets, leading to increased volatility. October 1987 market crash. The U.S. financial markets experienced turmoil in mid-October 1987, culminating in the Black Monday crash on October 19, when the stock market plunged by 23% in a single day. The crash was triggered by concerns over U.S. dollar stability and rising bond yields. Impact on securities firms. the crash marked the end of the securities industry's boom. Hiring freezes and layoffs became common as firms realized the era of steady stock market gains was over. For instance, Salomon Brothers laid off 1,000 employees on the day of the crash. Salomon Brothers turmoil, the firing of Louis Ranieri, a pioneer in mortgage-backed securities, in the spring of 1987 and the departure of Henry Kaufman at the end of the year indicated growing instability at Salomon Brothers. This led to a talent drain as competitors poached top talent. Industry overcapacity. The crash highlighted overcapacity in the securities industry. Many firms, including prestigious ones like Salomon Brothers, faced pressure from falling revenues and rising costs. Lew Preston's vision for Morgan. Lew Preston, aiming to restore Morgan to its former prominence, envisioned it as a universal bank engaging in both wholesale banking and investment banking. However, challenges included rapid employee growth, transition in business models, and high costs. Strategy challenges. Preston admitted uncertainty about the exact future of Morgan but outlined a hybrid approach, maintaining core banking while adding securities capabilities. He rejected the idea of turning Morgan into an investment bank or selling Morgan Guaranty. Management committee formation. Preston established a management committee to integrate policy and planning with daily management. This committee aimed to foster efficient issue analysis, quicker decision-making, and better communication. John Olds' role. John Olds was tasked with building out JPMorgan Securities and Corporate Planning Group, CPG. He focused on expanding client coverage, tightening costs and controls, and integrating various subsidiaries under a central administrative unit. Securities business expansion. By the end of 1988, Morgan had made significant progress but still lagged behind full-fledged broker-dealers like Goldman Sachs and Morgan Stanley. The focus was on expanding product offerings and investor coverage. Prescient shakeout. The CPG anticipated an industry shakeout starting in 1989 due to excess capacity and pressure on operating margins. This prediction proved accurate as the securities industry faced significant consolidation. London office challenges. Morgan's London office experienced difficulties after the Big Bang deregulation in 1986, leading to spending cuts and staff reductions as revenues fell short of expectations. Drexel Burnham collapse. Drexel Burnham Lambert, a major player in the junk bond market, collapsed in 1990 due to illegal activities by Michael Milken. This highlighted the risks of aggressive financial practices. Morgan's ethical dilemma. Morgan grappled with whether to engage in hostile takeovers, ultimately deciding to advise Hoffmann La Roche in its bid for Sterling Drug Inc. under strict ethical guidelines to maintain its reputation. Universal banking vision. By the late 1980s, the vision of many major banks was to become universal banks, offering a full range of financial services globally. Morgan pursued this model, anticipating industry reforms and increased competition. Regulatory environment. The Federal Reserve began allowing commercial banks like Morgan to underwrite corporate debt offerings, setting the stage for the eventual repeal of the Glass-Steagall Act in the late 1990s. Competition from investment banks. Investment banks gained power in the early 1980s as corporate customers increasingly relied on capital markets. Morgan Stanley's dominance waned as other firms excelled in underwriting and distributing securities. Shelf registration ruling. The SEC's allowance of shelf registration transformed the securities industry, benefiting firms like Salomon Brothers that excelled in pricing and distributing securities. Mega mergers. Notable mergers included Salomon Brothers with Phillips Brothers and Credit Suisse with First Boston, which allowed these firms to navigate the challenging regulatory environment and expand their global reach. 10. Should Morgan rescue Citi? Monitoring Citibank. In 1989, Morgan closely monitored Citibank due to its crisis involving problematic loans in commercial real estate and highly leveraged buyout, LBO, transactions, reminiscent of its previous issues with less developed country, LDC, loans. Crisis severity. By mid-1990, Citibank's non-accrual loans nearly equaled its equity capital, signaling potential insolvency. Citicorp's share price dropped 70% from its 1989 peak. Morgan's opportunity. A rumor circulated within Morgan that top executives Lew Preston and Dennis Weatherstone could have acquired Citibank for $10 per share but passed on the opportunity. The correct account reveals they were approached to acquire 10% stake in Citi by Federal Reserve's Gerald Corrigan, but declined due to potential negative consequences for Morgan. Morgan and Citi relationship. Historically, Morgan and Citi were rivals with shared business interests. They collaborated on various financial crises, including the LDC debt crisis and the New York City financial difficulties in the 1970s. The relationship was cordial under leaders like Walter Wriston, Citi, and Lew Preston, Morgan, but soured when John Reed took over Citibank in 1984. Reed's management, Reed, with a background in technology and consumer credit, lacked experience in international banking and LDC loans. Initially cooperative with the Baker Plan for LDC loans, Reed later took a unilateral decision to write off LDC loans in 1987, angering other banks, including Morgan. This led to a major loss in the banking industry and damaged interbank cooperation. Impact on Citi's LDC debt. By 1989, deteriorating conditions in Argentina, Brazil, and Venezuela led to significant arrearages in Citi's LDC debt portfolio. Morgan's former chairman John Meyer proposed the creation of Brady bonds to convert illiquid loans into marketable debt instruments, marking a turning point in the management of LDC debt. Citi's real estate crisis. Concurrently, Citi's aggressive lending to commercial real estate and LBOs resulted in significant financial stress. By 1991, nearly 43% of Citi's $13 billion in commercial real estate loans were non-performing, leading to substantial write-offs. Morgan's assessment. Morgan's corporate planning unit concluded that Citi was severely undercapitalized, poor at credit risk assessment, and facing potential systemic risks. They recommended limiting exposure to Citi and urged the Federal Reserve to take bold actions to prevent a broader financial crisis. Federal Reserve involvement. The Federal Reserve, led by Corrigan, pushed Reed to take drastic measures, including shrinking Citi's balance sheet, cutting its dividend, and raising $4 to $5 billion in new capital. Reed, however, resisted these changes. Morgan's reluctance. Despite recognizing the potential for long-term financial gain, Morgan's management declined to invest in Citi. They were concerned about the unknown risks, lack of control, and cultural differences between the two institutions. They also doubted the ease of turning Citi around and were wary of diluting Morgan's reputation. Outcome: Reed eventually secured a $590 million investment from Saudi Prince Al-Walid bin Talal in 1991, which proved highly profitable. This investment stabilized Citi without Morgan's involvement, allowing the bank to avoid the systemic risks that Morgan feared. Citi's crisis-prone nature. Citi's history of crises, dating back to its founding, was attributed to its aggressive management style post-1909 and its reliance on government bailouts. Over-leveraging and underestimating credit risks in various sectors, including real estate, LBOs, and asset-backed securities, left Citi vulnerable during downturns. Morgan's decision not to rescue Citi was ultimately seen as avoiding a potentially disastrous entanglement. The complexity of the deal, along with cultural and operational differences, led Morgan to prioritize its stability and reputation over acquiring a stake in its struggling rival. 11. Preston's legacy: early life and military service. Lew Preston enlisted in the Marines at 18, shortly after graduating from St. Paul's School in 1944. Served in China, protecting railways from Mao's guerrillas after Japan's surrender. Returned to the U.S., demobilized as a sergeant, and entered Harvard, graduating in 1951. Career at Morgan. Preston joined Morgan post-Harvard, quickly rising through the ranks. Known for his intelligence, courtesy, and inner steel, embodying the old-school Wall Street ethos. Early career highlighted by international expansion, especially in London and Latin America. Led Morgan's international division, overseeing the expansion of cross-border lending. Played a key role in the eurodollar market and petrodollar recycling. Leadership style and challenges. Preston's leadership style was deeply influenced by his military background and respect for General Joe Stilwell's decisive leadership. Initially tough and self-assured, focused on international expansion and challenging the Glass-Steagall Act restrictions. The Latin American debt crisis in the early 1980s profoundly impacted his leadership, making him more cautious and less decisive. Despite challenges, Preston took decisive actions during crises, partnering with Deutsche Bank's Alfred Herresen to manage the crisis and maintain the integrity of lending syndicates. Impact of the Latin American debt crisis. The crisis changed Preston's demeanor, leading to a more cautious approach to Morgan's future strategy. He hesitated to write off problem loans, hoping to salvage value, unlike competitors who took immediate write-offs. The Gebauer affair in 1987, where a Morgan executive misappropriated funds, further strained Preston, affecting his decisiveness. Strategic decisions and Morgan's transformation. Preston merged Morgan's national and international divisions, trying to realign the bank's resources with global opportunities. Expanded trading activities abroad and selectively in the US, though reluctant to push into retail banking, contrary to trends among competitors. Advocated for investment banking involvement but was tentative about acquisitions, preferring organic growth. His reluctance to embrace retail banking or fully leverage Morgan's private banking and investment management potential was seen as a missed opportunity by some. Health issues and leadership succession. Preston's health deteriorated in the late 1980s, possibly influencing his decision-making. He collapsed in 1988 and underwent a scheduled angioplasty, with subsequent signs of cancer suspected. Dennis Weatherstone was positioned as his successor, ensuring continuity at Morgan. Legacy at Morgan. Preston is recognized for navigating Morgan through the tumultuous 1980s, maintaining its AAA rating, and laying the foundation for its transition into investment banking and securities. Despite his cautious approach, Morgan was the only U.S. bank to retain its AAA rating, solidifying its preeminence under his leadership. Role at the World Bank. Preston was appointed head of the World Bank in 1991, following a long career at Morgan. His tenure at the World Bank saw the entry of former Soviet republics and a focus on public sector restructuring, environmental issues, and poverty alleviation. Preston clashed with regional directors but maintained a steady hand on the bank's mission, even as he streamlined its sprawling bureaucracy. Personal traits and humor. Known for his reticent and private nature, Preston rarely spoke about himself or his accomplishments. Despite his stern demeanor, he had a softer side, demonstrated by his fondness for humor and giving colleagues nicknames. Preston's interactions with colleagues and his anecdotes, such as golfing mishaps and humorous exchanges, reveal a more relatable side to his personality. 12. Preston passes the baton. Preston's announcement. In September 1989, Louis T. Preston announced his retirement as chairman and CEO of JPMorgan, effective January 1, 1990. He would continue as chairman of the executive committee. Dennis Weatherstone's promotion. Preston announced that Dennis Weatherstone would succeed him as chairman and CEO. Sandy Warner would become president, while Roberto Mendoza and Kurt Viermetz were appointed as vice chairman. Weatherstone's background. Weatherstone's background differed significantly from previous Morgan leaders. He came from humble beginnings, did not attend college, and started his career as a teenager at Guaranty Trust Company. Weatherstone's career. Weatherstone served in the British Army during World War II, rejoined the bank afterward, and developed trading skills in the London dealing room. His expertise was crucial as foreign exchange markets grew. Morgan's evolution. The Guaranty Trust merger revealed that Morgan had strong client relationships while Guaranty excelled in markets. As global trade expanded, Morgan's clients increasingly needed capital and hedging strategies. Preston and Weatherstone's partnership. Their partnership was effective due to Preston's hybrid banker-trader skills and Weatherstone's market expertise. Both grew in influence during the transformation of banking through globalization. Weatherstone's influence. By 1973, Weatherstone had been integrated into Morgan's headquarters, where Preston began clearing space for him, allowing Weatherstone to head the foreign exchange dealing room and later become the bank's treasurer. Key departures. Several senior executives left Morgan during this period, including Ralph Leach, a pioneer in federal funds trading, and Frank Smeal, who led the municipal bond desk. These departures made way for Weatherstone's rise. Strategic changes. Preston's strategic moves included merging the national and international divisions of the bank to strengthen Morgan's global presence. Some senior executives resisted these changes, leading to further departures. Leadership style. Preston was known for testing his senior managers with challenging assignments. While successful in some cases, this approach also led to a cautious culture among those who feared pushing the limits. Morgan's transformation. Preston's decision to transform Morgan into a hybrid commercial investment bank was crucial. He consulted Weatherstone extensively during this period, with Weatherstone becoming increasingly involved in key decisions. Weatherstone's leadership. Upon succeeding Preston, Weatherstone maintained a leadership style that was more consultative but still kept managers on a short leash. He was adept at financial markets but faced challenges in running a full-service bank. Sandy Warner's selection. Sandy Warner was chosen as Morgan's president and eventual chairman and CEO, a decision made after Preston was diagnosed with cancer. Warner's background fit the traditional Morgan profile, but his tenure saw significant organizational changes. Warner's career at Morgan included various roles, from regional management to leading corporate banking in London. His leadership was instrumental in Morgan's expansion in the UK and beyond. Warner's impact. Warner reorganized corporate finance in the US and the UK, which led to some friction within the bank. His leadership style was seen as tough, yet he played a crucial role in Morgan's strategic direction. Press reaction. The press largely praised Preston's succession plan, highlighting Morgan's strategic achievements under his leadership, including the expansion into deal-making and securities ventures. Criticism of Morgan's strategy. Some critiques, such as those from Euromoney, questioned whether Morgan's blue-chip client base and conservative strategy could deliver adequate returns, noting the bank's reluctance to diverge from its traditional model. Market positioning. Despite critiques, Morgan's management team was committed to forging its path, distinct from other securities firms, maintaining its reputation as a blue-chip banking firm. Part 3. Executing the Plan 13. Taking stock. Plans for the early 1990s shift in business model. By mid-1990, JPMorgan had shifted significantly from traditional banking to securities and investment banking, with a focus on fee-based services rather than net interest margin. Economic context. The U.S. economy faced a mild recession following the oil price spike due to Iraq's invasion of Kuwait, leading to struggles in commercial real estate and leveraged loan sectors, though Morgan had minimal exposure. Strategic planning. The Corporate Planning Group, CPG, was tasked with completing Morgan's transformation into a securities and investment banking powerhouse, anticipating a turbulent financial environment in the 1990s. Key observations. Capital and hiring. Morgan increased capital spending and hiring despite a weak economy. Industry conflicts. Financial institutions faced conflicts between proprietary trading and client-driven services.